Hey everyone, in this video I will try to explain how the options chain works with examples on Interactive Brokers Trader Workstation. So, what are options? Options are basically contracts that provide the holder with the right to either buy or sell the underlying security, which is usually a stock or an ETF. Call options provide the right to buy the underlying security, and put options provide the right to sell the underlying security. Although options started as a form of insurance for large portfolios, they are frequently used to speculate on price movements, and I'm sure you have seen multiple posts online of people claiming to make fortunes by trading these contracts. Well, if you want to trade them, you need to have a good grasp of how the options chain works. At first sight, it seems complicated or even intimidating, but in reality it's much simpler than it looks. So let's get right into it. As you can see, I am using the Trader Workstation platform by Interactive Brokers. I have a separate video with instructions on how to create a setup or layout for trading options, and you can check it out if you want to. The setup I am using here is not ideal for trading, obviously, but I think it's good for understanding the basics of the chain. All the values and data displayed on the chain are related to a specific underlying asset, which you can choose by typing its ticker in the box over here. Right now, the underlying that I have chosen is SPY, which is an ETF tracking the performance of the S&P 500 index. But everything that I will show in this video applies to other underlying assets, such as, for example, Apple stock. All you have to do is type AAPL and enter here, and it will load up Apple options. So let's go back to SPY. So you can think of the options chain as a multi-dimensional array, a multi-dimensional table. Let's call the rows of the table the vertical dimension, and also think of the columns of the table as the horizontal dimension. So the main element of the vertical dimension, positioned in the middle of the chain, is the strike price. It is the price at which the holder of the contract can either buy, in the case of call options, or sell, in the case of put options, the underlying asset. The horizontal dimension displays two sets of various information, which we will explain later, for the two different types of options, calls and puts. You can imagine that call options with a strike price below the current price of the underlying asset, also known as in-the-money call options, will be worth more than call options with a strike price above the underlying's current price, also known as out-of-the-money call options. That's because the holder of an in-the-money call has the right to buy the security below its current market price. The same logic applies to put options. Out-of-the-money put options, which have a strike price below the current price of the underlying asset, will be worth less than in-the-money put options, which have a strike price above the current price of the underlying asset. That's completely reasonable because the holder of an in-the-money put option has the right to sell the underlying at a price that is greater than its current price. So, as you can see, the upper left quadrant of the chain displays information for in-the-money calls. You can easily tell they are in the money because they are highlighted blue. And the lower left quadrant displays the same information for out-of-the-money calls. Similarly, the upper right quadrant displays information for out-of-the-money puts, and the lower right quadrant displays information for in-the-money puts, which are also highlighted in blue. So, what exactly is the information displayed? Bid and ask are straightforward, I think. Bid is the price that the buyers are willing to pay for each option, while ask is the price the sellers are willing to take. As you can see, the bid-ask spread, which is the difference between the two, is pretty tight because SPY options are among the most liquid. Delta is an estimate of how much the option value will change given a $1 change in the underlying asset. Vega represents how much the option value will change for a 1% change in the underlying asset's implied volatility. The implied volatility of SPY is displayed in the upper right corner of the options chain over here. And as you can see, it is currently at 11.2%. Imagine that if a large sell-off happens, the implied volatility will rise, and as a result, options will become more expensive. So moving on to theta over here, it represents the rate at which the option depreciates as time passes, and this is why it is also known as time decay. Delta, Vega, and theta are three of the most important Greeks, which I recommend studying carefully if you plan on trading options. You can display more Greeks in your options chain by clicking on the chain settings configuration here, and then layout. You can expand the Greeks and add the ones you want by double clicking on them. So let's close this window. Finally, there is an additional dimension to the options chain, which is basically a time dimension, and it is related to the fact that all options have an expiration date. So over here, you can see that the options displayed expire in January 19th, 2024. There are multiple expiration dates, and you can see them by clicking on the More button and then on the desired expiration date. For example, let's choose February 16th. So as you can see here, longer dated options are more expensive since they have more time value. So that's about it. Thank you for watching.